Here's something that might surprise you. As a small business owner, you have access to retirement accounts that let you contribute up to 10 times more than what regular employees can save. I'm talking about the difference between a standard employee limit of 23,500 per year versus structures that legally let you contribute 70,000, 80,000, or even 200,000 annually while slashing a tax bill. But here's the problem. Most business owners I talk to either pick the first retirement account their accountant mentioned, or worse, they haven't set one up at all because they're overwhelmed by the options. I'm about to break down 4 main retirement account types available to small business owners and show you exactly when each one makes sense. They give you a simple framework to choose the right one for your situation. Look, I get it. When you're running a business, retirement planning competes with about 1,000 other things and other priorities. You've got payroll to make, customers to serve, and that weird noise your computer keeps making that you're hoping will just stop. But here's why this actually matters right now. The retirement account you choose isn't about putting money away for the future. I mean, that's one of the things, but it's one of your most powerful tax strategies you have today. Regular W-2 employees can contribute $23,500 to the 401k in 2025, with a catch-up contributions if they're over 50, that goes up to $31,000. But as a small business owner, you have options that go way beyond that. You contribute up to $70,000 with a solo 401k or a SEP IRA, up to $77,500 if you're over 50. And with certain structures, even more than that. The right account structure can literally save you tens of thousands in taxes every single year. But the right account depends entirely on your specific situation, your income level, whether you have employees, and how much complexity you're willing to handle. So I've spent over 15 years helping small business owners optimize their retirement strategies. I can tell you that most people are working with incomplete information. The rules change significantly, especially with recent legislation like the Secure 2.0 Act. And what worked 5 years ago may not be applicable or optimal today. What I'm about to share are the exact structures I help clients evaluate every week. This is educational content, again, not personalized financial advice. So talk to your CPA or financial advisor about your specific situation. But what I can do is give you the framework to have a much more informed conversation with that professional. So let's dive into your 4 main options, starting with the most popular choice. So option 1, solo 401k, or also called an individual 401k or I-401k. The solo 401k is probably the account you've heard the most about, and for good reason. It offers the highest contribution limits with reasonable complexity. So here's how it works. You can contribute in 2 ways. As the employee, you can contribute up to $23,500 in 2025. If you're again age 50 or to 59 or 64 or older, you can add $7,500 catch-up contribution for a total of $31,000. And here's something new. If you're between age 60 and 63, you can add an $11,250 catch-up contribution for a total of $34,750. As the employer, you can contribute up to 25% of your compensation. So the total combined maximum for 2025 is $70,000 or $77,500 if you're eligible for that standard catch-up contribution. So let me make this concrete with an example. Say you're a 45-year-old consultant earning $200,000 in net self-employment income. You can contribute $23,500 as the employee. Then again, as the employer, you can contribute 20% for self-employed individuals. That's $40,000. Your total contribution would be $63,500. That's $63,500 in tax-deductible retirement savings in 1 year. Now, the solo 401k has some important requirements. It's best for proprietors or businesses with no employees except your spouse. It works great if you have high income, generally $100,000 or more. You get to maximize contribution flexibility, but you need to be comfortable with moderate administration. The key limitations: you can't have full-time employees besides your spouse. Part-time employees may need to be included after certain eligibility thresholds, and you may need to file annual reports once your assets exceed a certain level. So the solo 401k really shines when you're high earner flying solo. If you have employees, things get significantly more complex, which brings us to option 2. Option 2 is the SEP IRA. That stands for Simplified Employee Pension, or SEP IRA. If the solo 401k is the sophisticated option, the SEP IRA is the no BS retirement account. It's incredibly simple to set up and to maintain. So here's how it works. You can contribute up to 25% of your compensation with a max of $70,000 in 2025. The maximum compensation that can be considered is $350,000, and the minimum employee compensation for eligibility is $750. The beauty of the SEP IRA is its simplicity. You can set this up at Vanguard, Fidelity, Schwab in literally 10 minutes. No complex paperwork, minimal annual filing requirements, almost zero ongoing administration. You open the account online, takes about 10 minutes. You contribute whenever you want. It's fully flexible, and that's it. Seriously. But here's a critical thing you need to understand. If you have employees, you must contribute the same percentage for them that you contribute for yourself. So let's say you run a small marketing agency and you make $150,000 and you can decide to contribute 15%. That's $22,500 for you. But you have 3 employees making $50,000 each. You must contribute 15% times 50,000 times 3 employees. That's another $22,500 for them. So your total annual cost would be $45,000. Now, this isn't necessarily bad. Providing retirement benefits helps you attract and retain talent, but you need to run the numbers for your specific situation. To the flip side, you can contribute 0 one year if cash is tight, then max it out the next year when business is booming. That flexibility is a superpower of the SEP IRA. The SEP IRA is best for variable income businesses, solo practitioners, or very small teams, and people who value simplicity over complexity. Generally, those with incomes under $200,000 and anyone who wants year-to-year contribution flexibility. One important note, if you're self-employed, the calculation is actually 20% of net self-employment income due to how self-employment tax works, not 25%. Talk to your CPA about the exact calculation for your situation. So option 3, the Simple IRA. That stands for Savings Incentive Match Plan for Employees. The Simple IRA is designed for businesses with up to 100 employees, and it's a middle ground between the SEP IRA and a full 401k. Here's how it works. On the employee side, your employees can contribute up to $16,500 in 2025. If they're age 50 or older, they can add another $3,500 catch up for a total of $20,000. If they're between 60 and 63, they can add another $5,250 catch up for a total of $21,750. On the employer side, you have a choice. Option A, you can match employee contributions dollar for dollar up to 3% of compensation. Or option B, you can make a 2% non-elective contribution for all eligible employees, regardless of whether they participate. So here's why this can be genius for a small business with employees. Let's say you have 4 employees. You make $120,000 and your employees make $60,000 each. With the Simple IRA, using the 3% match, you can contribute $16,500 for yourself. If your employees don't participate, you pay 0 in matching. If they all max out the match, you pay 3% times 60,000 times 4. So 4 employees. So that's $7,200. Compare that to a SEP IRA, where you'd have to contribute the same percentage whether they participate or not. The Simple IRA puts the choice on your employees. So now there are some key requirements. It must be offered to all employees with $5,000 or more in compensation in 2 of the last 5 years. There's a 2-year waiting period before funds can be rolled into another account. The contribution limits are lower than solo 401k or SEP, and employer contributions are mandatory once the plan is established. The Simple IRA is the best for businesses with 5 to 100 employees, especially when employees may not participate heavily. It works well if you have if your income is between $75,000 and $150,000. You want to offer benefits without a huge cost, and you want a lower administrative burden than a traditional 401k. So option 4, the defined benefit plan, also called a cash balance plan. All right, this one is completely different from everything we've talked about so far. And for high earning business owners who are 45 or older, it can be a game changer. So here's the concept. Instead of a defined contribution limit like the other accounts, you're working backwards from a defined benefit at retirement. The plan calculates how much do I need to contribute now to reach a specific retirement goal. So for 2025, the maximum annual retirement benefit is $280,000 per year, or 100% of your highest 3-year average compensation, whichever is less. The older you are, the closer to retirement, the more you can contribute because there's less time for money to grow. This is why a defined benefit plan works best for business owners 45 or older. Now, before you get excited, let me give you the reality check of these plans. Defined benefit plans require professional administration with actuarial calculations. There are ongoing administration costs, typically several $1,000s annually. You need to commit to contributions generally for 3 to 5 years or more. There are complex compliance requirements. They work best for high, stable income, and they're most effective with minimal or no employees. So defined benefit plans are best for business owners earning $250,000 or more, ages 45 and up. The math gets better the older you are. you need stable, predictable income, minimal or no employees, you're 5 to 10 years from retirement, and you want maximum tax deductions. I typically see sophisticated business owners use these when they've had massive income year, or maybe you just sold a major contract, exited part of a business, or have a windfall income situation. You can make substantial tax deductible contributions and accelerate your retirement savings significantly. So here's a pro tip. Many business owners actually combine a defined benefit plan with a solo 401k. So you might contribute, say, $70,000 to your or more to your solo 401k and make substantial defined benefit contributions in the same year, creating a 6-figure tax deduction. But again, this is complex territory that absolutely requires professional guidance from a pension administrator or a tax professional. All right, let's bring this all together with a simple decision framework. Ask yourself these questions in order. Question 1, how many employees do you have? If it's 0, just you, maybe your spouse, solo 401k is likely your best option. If you have 1 to 20 employees, look at a simpler SEP IRA. If you have 20 to 100 employees, a simple IRA makes sense. And if you have over 100 employees, you'll need a traditional 401k plan. Question 2, what's your annual income level? Under 100,000, a simple offers lower admin costs with still good limits. Between 100,000 and 200,000, look at a SEP IRA or a solo 401k. Over 200,000, a solo 401k, possibly a defined benefit plan. And if you're making 250,000 or more and you're age 45 or older, seriously explore a defined benefit plan. So question 3, how stable is your income? If it's variable or unpredictable, go with a SEP IRA for maximum flexibility year to year. If your income is stable and growing, a solo 401k works great. If it's stable and high, consider a solo 401k or a defined benefit plan. Question 4, how much administrative complexity can you handle? If you want simple, go with a SEP IRA. If you can handle moderate complexity, look at a simple IRA or a solo 401k. And if you have professional support, like a bookkeeper or CFO, any option can work for you. So here's the quick reference. The solo 401k lets you contribute $70,000 to $77,500 in 2025. It's medium complexity. You can't have employees except for your spouse. It's best for your income levels, $100,000 to $200,000 and up. A SEP IRA also lets you contribute up to $70,000. It's low complexity. You have employees, but it gets costly. It's best for income, $75,000 to $200,000. A simple IRA allows $16,500 to $21,750 in employee contributions. It's low complexity. It works well with employees and is affordable. Best for income, $75,000 to $150,000. The defined benefit plan contribution amounts vary significantly by its age and income. It's high complexity. Having employees gets complicated. It's best for income, $250,000 and up, especially if you're age 45 or older. So here's what I need you to understand. You are not locked into your first choice. As your business evolves, as your income grows, as you hire or part ways with employees, as you get closer to retirement, your optimal strategy will change. I worked with clients in the past who started with a simple IRA at $80,000 income, upgraded to a solo 401k at $180,000, and added a defined benefit plan on top when they hit $350,000. Your retirement strategy is to scale with your business success. So here's exactly what to do in the next 7 days. Step 1, calculate your contribution capacity. Look at your current income and business structure. Be honest about your stable annual income, your current employee situation, and how much you can realistically contribute this year. Step 2, start simple. If you don't have any retirement account yet, set up a SEP IRA this week. Look at Vanguard, Fidelity, or Schwab. It takes 10 to 15 minutes. Don't let perfect be the enemy of good. Having some retirement account beats having none while you research the optimal option. Step 3, schedule a professional consultation. If you're already contributing or making over $150,000 annually, schedule a meeting with a CPA or a financial advisor who specializes in small business retirement strategies. Ask them specifically, should I upgrade to a solo 401k? Would a defined benefit plan make sense for my situation? What's my optimal contribution strategy for my current income and tax bracket? If I hire employees next year, how does that change things? Remember, every dollar you contribute is a dollar you're not sending to the IRS, instead building your own financial future. The difference between doing this right now and doing it wrong is literally hundreds of thousands of dollars over a career. If this breakdown was helpful, hit that subscribe button. I release new small business tax and financial strategies every week that could save you thousands. Drop a comment telling me which retirement account you're currently using or which one you're planning to set up based on this video. I read every comment and often create follow-up videos based on your questions. And if you have any questions or anything, just drop those in the comments as well. Now go set up a retirement account. Stop leaving money on the table for your future self will thank you. See you in the next video. And again, as a disclosure, make sure you talk to a financial, professional, as these are not individualized and just purely for educational purposes. But until next time, cheers.